This is Ash Heatwell, Director of Wealth Management at Graves Light Lenhart Wealth. In this quarterly update, we'll provide a brief review of 2024, as well as several key economic and macro trends observed as we start the new year. We'll also speak to implications for portfolio positioning and how the ever-evolving market landscape is shaping our views on both the opportunities and risks present. In general, 2024 witnessed strong results across many asset classes. The S&P 500 benchmark achieved a total return of 25%, which was primarily driven by large U.S. tech stocks. Value stocks, represented by the S&P 500 Value Index, achieved above-average long-term results with a gain of 12.3% in spite of weak results for the month of December. Mid-cap stocks followed a similar pattern to large value stocks, while the sharp decline in December experienced by small caps pushed the S&P 600's full-year return to below 10%. International stocks performed poorly during the fourth quarter in U.S. dollar terms, as worries about the change in the U.S. political landscape following the November elections led to significant currency movements. Increasing interest rates pressured bonds during the last few months of the year, with the benchmark Bloomberg Barclays Aggregate Bond Index squeaking out a total return of 1.3% for 2024 as a whole. Of note, commodities generated a solid total return of 5.4% for the year, helping to offset pressure from stubborn inflationary trends. The S&P 500 is an important equity benchmark and is often used as a measure of how the U.S. stock market performs over a given period. We agree that the S&P 500 is an important long-term guidepost for domestic stocks. However, movements of the S&P 500 have become highly dependent on a handful of extremely large tech stocks, and by definition, the index has become less diversified. During 2024, more than 50% of the entire S&P 500's return was derived from just 7 stocks, which are highlighted in the table on the left-hand side of the page. As the chart on the right shows, while the S&P 500 generated returns of 23% in price appreciation, so excluding dividends, during the calendar year, the aggregate return for the 493 stocks excluding the Magnificent Seven was 10%. In short, the headline performance was largely due to 7 very large stocks, while the average stock's performance, while still positive, only increased by roughly half of the headline amount. While the recent stock performance has been driven by only a small portion of the U.S. large cap market, we continue to be wary of the U.S. large cap space due to both valuation concerns as well as overall levels of market concentration. With only 10 names making up almost 40% of the U.S. large cap universe, as measured by the S&P 500, we are increasingly mindful of the risks of passively holding an index where performance is ultimately led by a named few concentrated positions, commonly known as the Magnificent Seven. The illustration on the right-hand side of the page demonstrates that over the long arc of time, such levels of index concentration have occurred but seldom persist. Stocks have performed well over the past few years, which has not gone unnoticed by individual investors. The chart on the left of the page shows that an unusually large percentage of small investors expect stock prices to continue rising. Typically, such surveys show enthusiasm near market tops and fear and/or disdain around bottoms. Professional investors as a group are bullish on stock prices during 2025 as well. Unfortunately, professional stock price projections are often wildly off the mark. The chart on the right shows the range of brokerage firm forecasts of annual stock market returns within pink columns, along with the corresponding black dots representing the actual yearly results. The historical record is not good. We find such projections to be of little help and do not factor such information into our investment management process. Rather, we attempt to take a clear-eyed view of the potential risks and return possibilities and focus on attractively priced securities that should help mitigate drawdown risk and enhance returns over time. The economy continues to remain on solid footing. The first official governmental report of real GDP for the fourth quarter of 2024 will be delivered after the completion of this video. But the Atlanta Fed GDP Now estimate of that growth is a healthy 2.7% annualized. Not illustrated here, the U.S. unemployment rate remains low at 4.1%. These solid big picture values suggest a healthy economy, with perhaps the most significant perceived risk on the horizon being that of inflation. Inflation peaked in June of 2022 at an annualized 9%. Federal Reserve action helped bring that inflationary bout under control, but inflation continued to measure 2.7% in November 2024, the most recent reading available. The Federal Reserve has recently cut rates, and while these cuts are expected to be supportive of economic growth, it remains to be seen what effects these rate cuts may have on inflation rates in the longer term. Markets are beginning to react to the possibility of valuation pressures on security prices if inflation remains problematic. This is not the first time in which we have communicated caution on U.S. large cap valuation levels. The reality is that stretched valuations, where investors are paying elevated prices for anticipated fundamentals, can persist for years, meaning that valuations in isolation are a poor timing tool. The chart on the left-hand side of the slide demonstrates this. Even though forward price to earnings multiples are well above historical averages for the S&P 500, investors have historically experienced a broad range of returns over the shorter term when valuation levels have been where they stand today. Returns have been both deeply negative and strongly positive on a forward one-year basis. However, when looking at forward 5-year returns, the annualized return level has generally been lower than long-term averages, with a tighter relationship to the valuation entry point. At some point, we believe markets will take greater notice of the currently elevated valuation levels. We simply do not know when that occurs. Looking to the right, the valuation matrix reveals a broader list of valuation points, which further indicates that valuations for U.S. large cap stocks are stretched, irrespective of the metric one chooses to use. Essentially, current investor assumptions may prove optimistic, leaving securities materially overpriced. Or as stated more directly by Warren Buffett, price is what you pay, value is what you get. Large growth stocks have dominated the global stock market over the past 2 years and drove the S&P 500 to substantial gains. Smaller domestic stocks, along with international equities, enjoyed gains but have lagged their domestic big cap brethren. However, earnings growth projections for small and mid cap stocks show in line to superior growth for 2025 and 2026. Historically, valuations in markets are negatively associated with future intermediate term returns. A risk with the current rich valuation of the S&P 500 is that the premium that investors pay to capture the future growth of earnings is already fully embedded in the price, meaning that any failure to meet earnings expectations may be harshly punished by the market. Meanwhile, the comparatively lower valuations of small and international stocks may provide greater upside opportunity to exceed market implied expectations, coupled with a possibly more forgiving downside in the event of economic weakness. International stocks have experienced frustrating relative performance over the past few years. The good news is that investor enthusiasm, as reflected in valuations, has dropped to historically attractive levels. In fact, the significant valuation disparity persists across all market sectors, which we believe provides the opportunity for greater future returns. Furthermore, non-US based stocks can provide portfolio diversification benefits, enhancing their attractiveness. Due to the combination of resilient growth and stubbornly high inflation, interest rates across key bond markets have generally remained volatile and equally elevated. The highlighted box on the lower left-hand side of the page provides a few examples of 2024 end-of-year yield levels relative to 2023 year-end levels. As illustrated, performance was broadly mixed yet positive. As interest rates are at higher levels, so are the coupons that bonds are required to pay to their investors. The higher coupon levels ultimately provide a greater buffer in instances where interest rate volatility persists. The right-hand side of the chart provides scenario analysis on the full-year return impact where interest rates to fall by 1%, rise by 1%, or remain flat. As reflected by the benchmark US aggregate, one can see that the risk-reward profile for a given change of plus or minus 1% in rates is positively skewed to a total return ranging from a 1% decline to a positive gain of 11%. Moreover, we also emphasize that while bond markets have recently had a mixed relationship with stock market performance, they are generally seen as a good diversifier were the underlying economic conditions to deteriorate. This is where many key bond markets are positioned to appreciate were a substantial economic slowdown to occur and interest rates decline, underscoring their relevancy in a diversified portfolio. The illustration on the page shows the starting monthly yields for the Bloomberg US Aggregate Index, a key benchmark for US investment-grade bonds, on the horizontal axis since 1976. The vertical axis represents the 5-year annualized return level for this index based on the entry yield level. What is revealed is the reasonably tight relationship between medium-term returns and the starting yield of this particular market. As of December end 2024, the yield for the Bloomberg US Aggregate Index was nearly 5%, which is close to the implied return on a forward 5-year basis. We view this yield as an attractive entry point for clients where fixed income is a component of their portfolio. Thank you for your time and interest. We hope that you found this information useful and that you are more comfortable with the positioning of your financial assets. As always, please let us know if you wish to discuss these or any other issues. We are here to help.